Well, welcome back once again. Here we are. This time you're going to have to put your thinking caps on, your memory hats on. We're going into Chapter 15 now, Real Estate Financing Principles. I will tell you, Chapter 15 and then whenever you get to Chapter 16, those two chapters have so many definitions and you need to know them, honestly. So let's get into the meats and potatoes and all the new definitions to add to your vocabulary. Well, we're going to talk about mortgage law, okay? Many of you may own a property today. Many of you may lease a property. We'll talk about down the road. But when you own a property, many times you go and take a loan out on the property, okay? A mortgage is a voluntary lien on real estate. And it will get paid based on when it was recorded, as we've talked about or will talk about. The borrower, which is you, you're known as the mortgagor. You pledge the land to the lender. The lender gives the money, and the lender is known as a mortgagee, okay, as security for the debt. See, you hear out there in the real world, go to Bank of America for your mortgage. No, no, no. You go and give a mortgage. Because, see, the lender gives you the money, the mortgage loan. You give the mortgage, the several pieces of paper you sign at closing, to the lender in case you don't pay. The mortgage is a security agreement that you will pay that debt. Just like when you purchase a car, they have you sign a contract. If you don't pay the car payments, they get to repossess it. Okay, so let's talk about mortgage law. As I said, there's confusing terms. The mortgagor is the property owner and gives the mortgage to the lender. The lender is the mortgagee. They're on the receiving end. They give the money. Okay, the mortgagee is the lender that gives the mortgage loan the money in exchange for the security agreement, in exchange for those papers, your signature. Key way to remember some terms in this course, okay? Key way to remember some terms. One chapter we'll talk about grantor, grantee. Grantor is the owner of the property. Then we're going to talk about lessor, lessee, you know, the property owner and the tenant. Lessor is the property owner. Trustor, creator of the trust, or is the owner. When you make an offer on a property, you're known as the offeror, the owner. The receiving end, receive, is the E, the mortgagee. The lessee is the tenant. They receive the use of the property. Okay, the trustee holds the trust for the benefit of a third party, the beneficiary. The grantee is the borrower in a transaction. The grantee has to be named in the deed, but does not sign the deed. Only the grantor does. So remember your ors and your e's. Maybe that might help you with some definitions throughout this course. As I said, words ending in or many times pertain to the owner. The vendor, that's when the owner does owner financing. You, the buyer, are the vendee. You're on the receiving end. Lessor is the owner of the property. Lessee, the tenant, receives the right to occupy the property. Mortgagor is the owner of the property. Mortgagee is the lender who receives the mortgage document from the owner in return for the money. Trustor is the creator or owner of a trust. The trustee is a person that holds the trust for the benefit of the third party. I already told you all that, and I'm repeating it because I want you to remember these definitions. So there's two parts to your mortgage loan when you take out a mortgage loan on a piece of property, whether it be residential, commercial, industrial, etc. One, you have the promissory note. That is your promise to repay the debt. Do you think a lender will only take your promise? Now, a promissory note is totally negotiable. You can negotiate the interest rate. You can negotiate if any points are paid. You can negotiate if there's a prepayment penalty. It's negotiable. Okay? You promise to repay it. Well, the lender knows us too well. They want more than our promise. Okay? They want the mortgage. We give the lender, the mortgagee, the mortgage. We as the mortgagor. The mortgage, then they record against your property. So that if you default, they have the right for the big F word, foreclosure. Hypothecation, that's a definition. What is hypothecation? That is when you pledge the property as security for payment of a loan without surrendering the possession of your property. Do you surrender the possession of your house to the lender with this mortgage? No, they're just putting a lien against your property. Sometimes you may hear deed of trust. Now, I want you to know, you've heard of a deed in trust. That's where the trustor created a deed and gave it to the trustee to hold for the benefit of the third party. That's a deed going into a trust. But here you're talking about a deed of trust. See that word of has an F in it, okay? That conveys title without the right of possession. It's a deed given as security for a loan by the borrower to the trustor or trustee who holds it on behalf of the lender. We don't use deeds of trust here in Illinois, but you should be familiar of this term. Easy way to remember, it's different than a deed in trust. It's a deed of trust. It has F in it. It's a financing document, okay? Promissory note, I told you, it's negotiable. It's executed or signed by the borrower, by you, also known as the payor or the maker. It states the amount that you owe, the time and method and how you're going to pay it, the rate of interest. It's a promise, but they want more than your promise. Interest, the lender is not going to give you a loan for free, okay? They're going to charge you for using their money, just like your credit cards charge you for using the money. So the interest you pay on the loan is a charge for using the money. The quicker you pay it off, the less interest you pay the lender. And lenders many times will charge a borrower a loan origination fee. That's part of a closing cost. That's charged to cover the expenses involved in the lender to generate the loan. Loan origination fees will pay for the processing of the loan, the photocopy of the papers, the loan officer's fees, the processor's fees, etc., etc. A loan origination fee will be a percent of the loan amount, not the purchase price. So if you're purchasing a property for $200,000 and the lender is charging you 1% loan origination fee, and you're taking out a loan for $150,000, $200,000 purchase price, $150,000 loan amount, the loan discount fee will be $1,500, 1% of the mortgage amount. Okay? Then lenders sometimes will charge you discount points. Discount points make up the difference between the interest rate the lender charges today and the rate of return demanded by an investor. You're buying down the interest rate, okay? One discount point equals 1% of the loan amount, not the purchase price. It is paid as prepaid interest on a loan, okay? And I'm going to tell you, with today's interest rates we have today, and the average time somebody spends in their property, usually people move usually every 5 to 7 years. It's really not worth paying many discount points. Because if today's interest rate is 4% and you want to pay 3% interest rate, okay? In order to buy down that interest rate to 3%, you have to pay 8 points. That's 8. Every discount point will reduce your interest rate by 1/8%. Not worth it. Unless you're going to stay there forever. Then maybe it might be worth it. So look at the odds, okay? Look at the odds. Prepayment in a promissory note, it'll tell you if you have a prepayment penalty. Some lenders on some types of loans will charge you a penalty if you pay the loan off sooner than required, or if you pay the loan off within the first 5 years of the loan. They don't want to lose all that interest, okay? Some lenders will charge a prepayment penalty. Now, one thing you will need to remember that we will be covering down the road is, remember, FHA and VA loans do not have prepayment penalties. They have what we call prepayment privileges. So you can close on an FHA loan today, win the lottery next month, and pay it off. the lender cannot charge you a penalty. Some conventional loans will have a penalty. So if you are wanting to list your house and you told me you just bought it 3 years ago, I may want to take a look at your promissory note and your mortgage documents, because maybe you had a prepayment penalty if you pay it off within the first 3 years, and it won't be the 3-year anniversary for 4 more months. We may want to wait to close on that property for a couple months, so you don't have to come up with extra money out of your pocket. So many buyers, that's one big thing they ask a lender is there a prepayment penalty? So there are duties of the mortgagor or the trustor in a mortgage document or in a deed of trust. What are some of your duties when you sign that security agreement with the lender? When you sign the mortgage? Well, you agree to pay the debt in accordance to the terms of the note. If the loan is due on the 1st of every month, and it's going to be late after the 15th of every month, you're agreeing to pay it that way. After the 15th, you have to pay a late fee. You're agreeing to pay it that way. You're agreeing to pay all the real estate taxes on the property. Sometimes if you have less than 20% down, you're a greater risk to the lender. The lender will require an escrow account, so when the taxes come due, they will pay them on your behalf, because they don't trust you because you're a higher risk because you put less than 20% down. You also have to maintain adequate homeowners insurance. The lender wants to make sure they're covered if your property is destroyed. Improvements can be destroyed, but the entire property cannot be destroyed because you own all the way down to the center of the earth and up to infinity. Okay? So a lot of times, if you have less than 20% down, the lender will require 1/12 of the insurance also to go into an escrow account. So when the insurance comes due next year, the lender will pay it and you don't pay it. Now, this next one, I drive through some areas and I don't think everybody follows this in their mortgage agreement with the lender. Maintain property in good repair all times. You think all homeowners maintain their property in good repair all times? Well, could that be a violation of their mortgage document? Yes, it could. It also says we need to get written authorization before making any major alterations to the property. I bet that's one thing people don't follow either. There's a clause in there. There's an acceleration clause. You know the accelerator in your car, the acceleration pedal? You know, if you default on a loan, okay, the lender can step on the gas pedal and call the entire loan due. So if you violate any clauses, they can call it due based on the acceleration clause. Remember that definition. Many of you, Mary, Mark, Bob, Sue back there, you own a home, correct? When you took out your mortgage, maybe you took it out with XYZ lender. Did you ever get notice from XYZ lender that as of January 1st, you had to start paying ABC lender? That means your current lender assigned the mortgage to a new lender. With an assignment, nothing changes. Everything stays the same. Sue, did your interest rate change? No? Did the monthly payment you make to the lender change? No? What changed? Who you wrote your check out to, right? The assignment just changes the name in a contract and all the terms remain the same. Release of a mortgage lien. There's a clause in there. You know, you make your last payment on that mortgage. Celebration time. Well, when a mortgage loan lien is released, there's a defeasance clause, okay? That requires the mortgagee, the lender, to execute a satisfaction of mortgage when the note's been fully paid. Now, I will tell you, they're going to mail you that satisfaction of mortgage. And it's up to you to record it, that it's paid. So let's say you had a first mortgage loan and a second mortgage loan. You paid off your second mortgage loan. It's your responsibility to record it. If you don't record it and you go and sell your property, the attorney's going to call me up when I list your property and then the contract comes on and you accept it. The attorney's going to call me up and say, Roseanne, did you know they had a second mortgage too? And they're going to owe money at closing? I go, no, they said they paid off. Well, then you're going to have to go dig through your paperwork and get that release that the lender sent you. tax and insurance reserves, also known as impound account, trust account, escrow account. That's many lenders require borrowers to provide a reserve fund for when the real estate taxes come due next year and the insurance premiums come due. Usually, all FHA and VA loans usually require, conventional loans, usually if you have less than 20% down, they require it. Also, two flood insurance reserves. We've all heard of FEMA. Mostly when Katrina was around, you heard of FEMA. The National Flood Insurance Reform Act of 1994 imposes certain mandatory obligations of lenders on loan servicers to set aside funds for flood insurance on new loans. Also, too, you should be aware when you purchase a property if it's in a floodplain or not. Now, when you purchased it, it may not have been in a floodplain. 2 years down the road, you may get notice from your lender because they just found out your property moved into a floodplain. They give you a specific amount of time to get flood insurance, otherwise they will get it and charge you back for it, okay? You own this property, let's say it's a 1 to 4 flat, 1 to 4 units. It's a 4 flat. You rent it out, okay? You rent it out. Now you stop paying the lender. Well, there's an assignment of rents in the mortgage document that you signed, the security agreement you signed with your lender. In the default of the borrower, in case of your default of the loan, the lender can go knock on the property door and start collecting the rent from the tenants, and you're not going to get the rent. Oftentimes, a lot of times, a court will appoint a receiver to collect the rents and manage the property for the lender. And many of you sometimes heard of buying property subject to or assuming a seller's mortgage or a deed of trust, okay? Subject to the mortgage, the buyer is responsible for making payments on a pre-existing debt, but is not held personally liable. I'm not going to go basically too much further in depth with that because that really doesn't exist that much today. Hardly ever, 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 okay? Buying a property subject to the existing mortgage. But what does exist today is assumption of mortgage. All FHA and VA loans, remember, are assumable. What does that mean? Well, today the buyers have to qualify with the current lender. But let's say this property comes on the market. The seller 4 years ago maybe paid $150. Maybe today it's only worth $170. Okay? And they put only 3% down, which was very little, right? How much do they owe today? They put 3% down. 3% of $150,000 is $4,500 roughly, right? So we're talking about they probably owe $145,000. Let's say it's only worth $170 today. Well, a buyer can come in. They have to qualify with the lender for that $145,000. And they can take over that loan where it's at today. If interest rates go high, up to 5%, and this loan is 3%, is that not a better value for somebody who has money down? Yes. Okay, assumption. Alienation clause, that's another clause. Okay? And also known as a due on sale clause. It has 2 names. You know, everything in this course has 2, 3, 4, 5, 6 names. Alienation clause provides that when the property is sold or interest is transferred, the lender can declare the entire debt due immediately. Okay? Think of owner financing. You own this property, it's a bad market, can't get it sold, so you say, hey, I'll do owner financing. Well, if you have a current mortgage on that property, and it's an alienation clause, which means it's due upon sale, and you do owner financing, well, and the lender finds out you transferred it, they're going to knock at your door and say, okay, Bob, pay up. $145 right in my hand. The entire debt is due immediately. Okay? The mortgage document and deed of trust must be recorded in the recorder's office in the county where the property is located. And always remember, the first lien to be recorded is the first one in payment, except for real estate taxes and special assessment. They're not required to be recorded. To take priority over all other liens, they automatically take priority. The government gets first place. Land contracts. owner financing, articles of agreement, etc., etc. They're all the same thing. Under a land contract, if you're the buyer of a property, you're known as a vendee. You agree to make a down payment and monthly payments. I, the seller, I retain legal title. You, as a buyer, you only get equitable title during the term of the contract. You get equitable title and you get to move into the property. And when you pay me in full or you go get your own mortgage loan on the property, then you'll get legal title. Now, in that mortgage document you signed with the lender when you first bought your property, I said, main thing people say, you know, if you don't pay, they foreclose. The big F word, right? Foreclosure. Foreclosure is the legal process in which a property that has been pledged for security is sold to satisfy the debt. The bank comes in and sells your property. You get evicted, eviction. In Illinois, methods of foreclosure. By statute, mortgage foreclosures may only be brought through court proceedings. As a result, if you have to go to court, you have to go see Judge Judy. Well, it's a judicial foreclosure state. You have to go see the judge. Here comes the judge, right? But there are 3 different types of foreclosures you should be aware of. Illinois is a judicial foreclosure. You must go to court and the foreclosure sale is then ordered. The sheriff carries out the sale, etc., etc. Another type of foreclosure is a non-judicial. So if it's non-judicial, that means no court, correct? No court. When you sign the mortgage document, let's say California is a non-judicial foreclosure state. You sign the mortgage document, that security agreement. In that agreement, along with the assignment of rents, along with the Defeasance Clause and the Alienation Clause, everything else, there was a power of sale clause, which means that you gave the lender the power to sell your property upon default. So they don't have to go to court to get that right to sell it. They already have it because you gave it to them in those papers you signed. That's a non-judicial foreclosure. Okay. Illinois mortgage documents cannot have a power of sale clause at all. Then there's the strict foreclosure. That's the 3rd type. Oh, that's 50% of judicial, 50% of non-judicial. 50-50. It's 50-50. It doesn't know what side of the fence it wants to be on. Here, the lender has to go to court, but simply the court gives them the title. There's no foreclosure sale. So the lender goes to court, sees Judge Judy, and Judge Judy hands over the title, but no foreclosure sale. Remember those 3 different types of foreclosure sales. Then there's what we sometimes call a friendly foreclosure, also known as a deed in lieu of foreclosure. Sometimes, in some cases, a lender may accept your deed instead of foreclosing. Known as a friendly foreclosure because it's carried out by mutual agreement between you and the lender. There's no foreclosure sale that will go against your record, your credit report. But in today's economy, today's real estate business, many lenders do not like them. That's why we came up with short sales. Why do lenders do not like deeds in lieu of foreclosure? Well, in a regular foreclosure sale, all the junior liens are washed off. The property's been foreclosed, goodbye, 2nd mortgage, 3rd mortgage, 4th mortgage, judgment, they're all wiped off. But when the lender takes the property, takes the deed instead of foreclosing on it, they take the property subject to all the junior liens. They get the judgments, they get the 2nd mortgages, they get the 3rd mortgages, etc., etc., etc. Okay? So many times before the lender, the mortgagee, will take a deed in lieu of foreclosure, they're going to want to do a title search to see what type of liens are really on that property. You have government programs out there for purchasers and for homeowners and that. There are government programs to help homes be more affordable. You have HAMP. HAMP is known as your Affordable Modification Program. Financially troubled borrowers modify the terms of their mortgage loan to a more affordable level. You know, many times people end up in foreclosure because they don't say anything when they start getting behind. When you start getting behind, start talking to your lender or an attorney. They can help you out. Don't wait till the foreclosure sale. Too late. You also have HARP, which is the Home Affordable Refinance Program. It's designed to help people, property owners who are not yet delinquent, to refinance their property. Be aware of those to help out your past clients or that. I recommend that they talk to their current lender or a real estate attorney. Some states allow a defaulted borrower, somebody who is defaulted on their real estate loan, mortgage loan, to redeem their property. There's two types of redemption out there: equitable right of redemption and statutory right of redemption. My memory tip that I thought up for you, how to remember the two different ones, is equitable right. Think of your alphabet, okay? A, B, C, D, E. Think of your alphabet. The letter E, stands for equitable, comes before the letter F, foreclosure, in your alphabet, correct? So equitable redemption is before the foreclosure sale. The letter S in our alphabet comes way long after the foreclosure sale, way long after the F. So statutory redemption is after the property's been foreclosed on. The owner still will have the right to redeem it. Now, in the foreclosure sale, if the lender does not receive enough money to pay off the loan and all the fees you owe them in full, they may be entitled to file a personal judgment against you, the mortgagor, a deficiency judgment for the unpaid balance. Even in a short sale, they don't receive all the amount. Many times they can file a judgment against the seller for what they did not receive. That's our chapter 15 with all those definitions you have. We have a lot. Now take out that mortgage document you signed to see if you can understand it a little bit better. We'll see you shortly.